I'm Tyler House, and welcome to the second episode of Inside the Trends, where we cover the financial performance trends from our benchmarking program, Regie Select. Each quarter, we'll take a closer look at what's really happening inside mortgage lending, using performance data from real mortgage companies. Today, we're looking at the retail IMB peer group results from the first quarter of 2026. Starting with production volume, Q1 came in essentially in line with the past 3 quarters. That's not unusual when you compare Q1 to Q4, but what is notable is that we're seeing Q1 holding up against Q2 and Q3 of last year, which are typically much stronger in a purchase-dominated market. And when we look at applications, we see that momentum continuing. Year-to-date through April, total applications are up 21% year over year. And looking specifically at April, production was still up 14% versus last year. These are all encouraging signals, especially with rates still in the 6% range, showing that even small improvements are enough to push borrowers off the sidelines and into action. The bottom line, volume trends are moving in the right direction. Now, profitability in Q1 is a bit of a mixed bag. On the surface, things look positive. Pre-tax net income averaged 21 basis points, and about 62% of lenders were profitable on a pre-tax basis. But when you isolate actual production performance, net production income came in at minus 29 basis points. That's a disconnect, especially since volume was slightly higher than the prior 3 quarters, where net production income was actually positive. So what's driving the gap? There are 2 main factors. First, servicing. MSR values improved slightly, about 2 basis points of improvement. That doesn't sound like much, but when MSR portfolio volumes are averaging 2 times annual production volume, that converts a 2 basis point increase in valuation into a 16 basis point gain in pre-tax income. The second driver, the lock pipeline. Higher application volume drove larger pipelines at the end of Q1, which added about 23 basis points to pre-tax income. Now, those are real revenue impacts, and they absolutely matter. But we exclude both of these items for the net production income because we want to isolate how the core origination business is performing. And on that basis, net production income declined in Q1. That said, there was still improvement on a year-over-year basis. Net production income was a minus 29 basis points this quarter versus a minus 38 basis points in Q1 of last year. So it's better than last year, but the improvement is less than I would have expected based on the production levels. The key pressure on net production income is coming from gain on sale. We saw a 29 basis point decrease in secondary gain on sale margins this quarter. That's important because strong margins have been a big reason why we've seen positive production income in the prior quarters. If this trend continues, to reach break even, lenders would need to offset this loss with either higher volume or meaningful cost reductions. To put that into perspective, at Q1 margins, lenders need about a 20% increase in volume or an 18% reduction in fixed costs just to break even. Now, this could be temporary, and we may see margins rebound in Q2. But regardless, the takeaway is the same. Cost discipline, product mix, and operational efficiency remain critical points of focus for operators this year. On a side note, we often get asked why exclude lock pipeline gains from net production income. The answer is simple, and Q1 is actually a pretty good demonstration of why we do it this way. Including the lock pipeline gains can distort what's actually happening with margins. For example, if we include those gains this quarter, it would look like gain on sale improved by about 10 basis points. But when you talk to secondary marketing leaders, they're going to tell you a different story on the trend. They're going to see margins tightening during the quarter, much more like the 29 basis point decrease in gain on sale that we observe when we exclude the lock pipeline. In conclusion, as we move further into 2026, the mortgage industry continues to show signs of recovery. But this quarter also reminds us that higher volume alone doesn't guarantee stronger profitability. The lenders that will perform best in 26 are those that remain financially disciplined, understand their numbers, and know how they compare within the market. Thanks for joining me for these trends. Each quarter, we will help you understand not just what the numbers say, but how to use them to make better, data-driven decisions. The data we covered today is just a small portion of the data available through Richie May's Mortgage Analytics Suite. To learn more about accessing our intelligence products and how they can empower your business, email me directly at tyler@richiemay.com. Thanks for watching. We'll see you next quarter.